first of all, I think a round of applause for Groww team for managing this show. I know them; they are running since morning, and also for the audience. They have been such an attentive audience on Saturday afternoon. So we'll get into it. Atul, we'll start with you. Uh, Atul, microcaps are often attractive because of their potential to scale from 500 crore to 5,000 crore. However, the downside can also be equally severe. There could be drawdowns for 50 to 60%. So, how do you distinguish between, whether you want to add when there is a sharp correction? Is that an opportunity, or is that a situation, where the thesis has broken down and maybe it's time to exit?
Okay. In my perception, whenever a sharp drawdown occurs, and if the basic thesis remains same, so if it is because of some temporary situation in macro environment or some policy changes or some a particular event, but the basic thesis remains same, then probably it's time to add more as it drops. Of course, if the thesis fails, then definitely at whatever loss, I will exit.
Can you also share an example?
Okay. Recently, there is a stock called Carnex Microsystems. So that Carnex Microsystems is into providing Kavach, which is anti-collision device to railways. This particular area has got three players, which are approved by railway. So it is a competition between three only, whereas the market is huge. With recent crash because of this Iran war, Carnex crashed to levels of 900 from roughly around from high of 1450. So that was a good point to add because nothing from the Iran war is going to change the prospects of the Carnex. So again, fortunately, it has within just these 2 months, it is again at high. So there we found it's a very good opportunity, like especially this Iran situation, where many sectors or companies where externalities are not there, maybe domestic play, domestic consumption, and assured payments. So Carnex was fitting into all this. So that was a good play to be there. Similarly, many other stocks like as one of my favorites, Frontier Springs. So it is supplying springs to railway. So it has nothing to do with this Iran situation. But because market falls, everything falls. So it also fell to levels of around 1200. So now again it is at level of 1700. So there are a lot many such cases. But if our basic thesis remains same, then definitely we'll add to it.
Balaji, would like to add to that?
Okay. So, between a microcap drawdown and a large cap drawdown, how we react is, in India, we have a situation where the largest traded stock in this country is Mota HDFC Bank and Reliance Industries. Every day it changes, sometimes it's 3,000 crores, sometimes it's 3,500 crores in a day. So, for context, the largest traded stock in the US, like Tesla and Microsoft, will probably do 10 times of that. Meaning Tesla will trade 30,000 crores in a day, Microsoft will do 30,000. So in a typical microcap, where as per SEBI definition, today 10,000 crores and below is considered as microcap. So today Ramakrishna Forgings, which is the 500 stock in India, from that and below is considered as microcap. So typically an anatomy of a microcap is where 50 to 60% is held by the promoters, another 5-10% is held by the family members and relatives. There is probably one fund or no fund. So effectively speaking, 20% of the float is what is available for you to trade. So if you're looking at a 2,000 crore company, so 20% of 2,000 crores is roughly 400 crores. So that is the only float that is available to trade. So the moves are going to be extremely exaggerated both ways, on the upside and as well as on the downside. Just because there is a very wild swing, that doesn't really mean that the premise is over or the thesis is gone. So it has to be evaluated just like how you would evaluate a large cap, and then accordingly take a call, and rather not panic, because if you look at the volumes, 10,000 shares of selling can really take the microcap down by 15%, 20%. and the other way around as well.
Also, when it comes to microcaps, it is always, seen as a segment where, where you can, if you have the information that others don't have, because there are a lot of stocks that are under researched, then you have a real edge. But in a scenario where, uh, what if, the stock probably that you have invested in now suddenly is, getting discovered by others? What would you do in that case? Would you exit, or would you, continue to hold on, because now institutional entry has in fact, maybe improved its prospects of, further price up move?
Okay. In any such case, it's very heartening to see that what we bought maybe at around 10 crore market cap is now reaching to 500 or 1000 or 2000 crore market cap, and wherein below which institutions will not enter. So once the institution enters, it's largely visible to all the investing community, and at least from there on, it becomes a steady compounder at least. So depending on the objectives of an individual, whether if something has done, let's say 10 bagger, 50 bagger for me, and I have another opportunity, in that case, becoming a compounder, I may exit there. Or if in terms of overall balance of the portfolio, where personally I'm mostly focused on microcaps only. But then once a position in a microcap, it grows sufficiently well, then it goes beyond microcap. But it will give stability to the portfolio. As we all know, microcaps are kind of a dark corner. So very little information is available in public domain, though it has increased in recent times. But yes, so depending on the objective, maybe like in specific case, this frontier string, so from roughly around 15 to 5400. But now the business is so stable and it's growing very well. So if I want to keep it as a stable element in my portfolio, it definitely it is going to be a good compounder from here on.
Balaji, like to add something?
So, typical journey of a microcap is where there is only promoters and friends with absolutely no funds. Then few HNIs discover it. There is a significant amount of HNI holding in the company. From there, it moves towards alternates like PMS, AIF, etc. From there, it becomes eligible for the mutual funds to buy into these companies. So one of the reasons why your BSE Midcap Index is trading at this 30, 35 odd P multiple, which people speak about, is the fact that the entire mid-cap universe is between 101st stock and the 250th stock. So there's only 150 stocks that the entire mid-cap mutual funds, which is getting say 15,000 crores, or out of the 30,000 crores, maybe 15,000 crores comes into the mid-cap segment. They are in a way forced to continuously keep on buying these companies, right? So 101 to 250. So beyond that is where actually, I mean, it's a very ironical thing that you see some large caps offering some great value, but there could be value traps for other reasons. And you have the middle pack, the mid caps, which is expensive. And then when you go down the curve, you do seem to find value, because it's impossible for a 30,000 crore mid cap fund to take 1% position, that is 300 crore position in a 1,000 crore stock or a 1,500 crore stock. So this is the exact excitement and the from the journey of being undiscovered to being completely widely owned. So I'll give you an example, not a recommendation. Astral Limited, which was earlier known as Astral Polytechnic. In way back in 2010, the company had a market cap of barely 300, 350 crores. Not a single fund was there, and this entire story was steel pipes to PVC and CPVC, continuous volume growth despite the Middle East crisis and all that stuff. And today we are at about a 50,000 crore kind of a market cap, widely owned by many funds as well. So this is how it typically works, in terms of the journey.
That's the journey. Yeah. Also, because of the same lack of information, how should investors go about doing their due diligence? Maybe Balaji, you can take that.
See, in this day and age, actually information asymmetry has dwindled big time. There is no excuse for that, considering that we have tools for that, and you can sit in the in Chennai and you can analyze a microcap in US or microcap in Brazil. So it's very easy to even analyze a microcap or a small cap company sitting in Chennai or Bombay or anywhere it is, because the kind of information which an institutional investor used to get at one point in time, the retail investor never used to get. But now, after SEBI regulations, today there are so many conference calls. When we used to track mid caps and small caps in Sundaram, which was my earlier avatar, we never used to have any PMSs or AIFs or individual investors asking questions in the conference calls. But today, if you go to any 5,000 crore or below company conference call, I don't find any mutual funds. It's only the PMS guys, the UHNI and individual investors who are asking questions. And with the availability of information, I don't think there is so much of a asymmetry for someone to worry about. Yes.
Atul, like to add?
Uh, yes, as many people have already burned their hands in microcaps in earlier a lot of cases where one doesn't really know whether the worth is there or not. As he rightly said, nowadays a lot of information is also available on public platforms. Plus, if I am putting my hard-earned money and giving a good allocation there, uh, a good network will help where you can connect with the management. Another very important aspect is that it is relatively very easier to connect with the management in microcap companies because they are not very big people. So many a times we have found that while visiting any management, in fact, it's a pleasure for them that no fund manager will approach them because of their size. So as compared to that, and there are a lot of such cases where we have discovered very good value in something really very unknown. So that is also an added factor where one can approach management, where we can go to the visit the plant, know it firsthand. So that will be important.
And Balaji, as you run a small cap PMS, what do you think is the ideal waiting period that investors should keep in mind before they can expect a good payoff from a small cap investment? Also, what should investors uh, approach be if the returns are not as per expectations?
So typically we follow an approach of looking at anywhere between 16 to 24 quarters. So that's about 4 to 6 years, right? So it's a very extremely dichotomous market. On the one hand, you have 200 P companies, and where a lot of growth has already been kind of factored in, and there is very little margin for safety. And on the other hand, you do have companies that are available at a cheap multiple, in the sense that there currently some kind of capex is ongoing and the project is yet to be commissioned, and therefore the near term earnings are expected to be subdued and they're not going to be big bang fireworks. It is at that point in time that you actually get a microcap or a small cap at an attractive valuation. So the best time to actually look at a microcap and small cap is when things are actually not so great, when there is an issue that is not unsolvable. That at that point in time, because markets are a voting machine in the short term, it's either going to get heavily punished or it's already kind of punished and kind of lackluster, and there is not a very significant interest. So you evaluate at that point in time and give management time to perform for maybe 16 to 24 quarters, and then you reassess your thesis. And one hard and fast rule that we have, and I'd look at personally, is these companies must be growing at 1.5 to 2 times the nominal GDP growth. Because if I want just 9, 10, 11%, which is our country's nominal GDP growth, none of us need fund managers. We just need a low cost Nifty index fund, and that will mimic the nominal GDP growth of the country. But if we are looking for very high teen growth, then we also need to look for those industries and categories that are growing at 1.5 to 2 times the nominal GDP growth for you to get the desired results.
And let's maybe look at some case studies. If you both of y'all can, maybe Balaji can talk about first. So if you can take us through some examples of your stock picks from discovery to exit, and both the scenarios where it worked and where it didn't work. Just a disclaimer: none of the stock mentions are or should be taken as recommendations?
So one example I'd like to mention is the situation that occurred in the wood panel industry. There's a company called Greenply Industries, which had an elder brother and a younger brother, and the younger brother was actually in charge of the MDF business of the company. Elder brother was doing the plywood business of the company. Then both the brothers wanted to demerge, and there was a new company called Green Panel Industries, which was carved out of Greenply Industries. So the demerger ratio was 1:1, and so by virtue of holding Greenply, anyone who held Greenply shares also obtained 1 shares of Green Panel Industries. So when the demerger happened and when the stock got listed, it had a starting market cap of around 300 odd crores only. And because some of the larger funds, given their size, a 300 crore, 350 crore market cap company would not really make sense for them. They were kind of exiting that counter. So one thing that we looked at when we came across is that the company had a gross block of around 1,200 crores, 1,100 crores. They had a debt of around 200 odd crores. So, and at that point in time, they had almost 400,000 cubic meter capacity. So, if someone had to replicate a 400,000 cubic meter capacity of MDF in India, they had to shell out 1,200 crores from their pocket. And the same company was available at 300 crores in the market. So, from starting valuation point of view, is a very, very rare probability that you're going to lose your capital. That's the rule number one. From there on, if the capacity utilization starts inching up, and which is also a function of the change in consumer behavior, because nobody is using a carpenter to make their furniture. They go to an IKEA or something like that, buy a ready-made furniture. So you have MDF industry which was growing at 1.5 times GDP at that point in time, and therefore the capacity utilization started ramping up, operating leverage kicked in, margins expanded. Then the kind of profit that they were doing in 1 year, they started doing in 1 quarter. So from a 300 crore company, it went to a peak of almost 12 crore equity into 600, around 7,000 crore market cap. And that was like, but it took its time, right? It took a good 3-4 years before this played out.
Atul, like to add?
Okay. Normally, what we try to look into this microcap space is if there are any surprises. So means stock is not discovered so far. Like in a case where I was just looking at, I went for buying one camphor pack for puja. So in fact, whenever we go to buy this particular product, normally nobody asks price, whether it is one particular sachet is available for 1 rupees or 2 rupees or 5, it doesn't matter. So I was just thinking that this is something which is absolutely price inelastic. So then we searched for, and we found one company. At that time, it was called Dujodwala Products. They were making this Mangalam brand camphor. So I checked with them, but they were not making good profits. We tried to connect with the management, but somehow they were not very eager to connect. So in a span of about 4 years, it went from about 15 to around 50, 55 levels. So as such was good. 4 times in 4 years was by any way a good thing. Then we were looking for any parallel companies in that sense. So we found one very small company called Kanchi Karpuram. It is based out of Chennai, and there are a lot of religious places around Chennai there. So we just connected with them, and we found that the demand was good. But then I asked them, why you are not expanding? If demand is good, you are running at 100%, why you are not expanding? Then they just said that we have already expanded. So trial productions were going on. So till the time they did not disclose. So maybe once that they start with commercial production, then they would disclose. Incidentally, along with that, because of subsequent COVID, that camphor went into very high demand. Because in Corona times, everybody rushed behind camphor. So that stock, particularly when we checked with initially, it was around 15 rupees price. So during this Corona journey, maybe in about 5 years, it went up to around 1200 rupees. So, but it's a commodity. So even at 1200 rupees, the market cap reached to something around 500 crore. So that is a micro cap even at that time. But looking to the nature of it commodity and a specific demand in Corona. So as soon as Corona receded, obviously demand was going to be low. So volume and price, both advantages were with Kanchi Karpuram. So at around 1200 level, at least we would book part. So like there are a lot of stories where such surprises come across. Like my at my home when I was going, I had one cupboard pending. So one carpenter came nearby, and I was just checking with him, and he was reluctant to do this thing for me. He charged very high. I allowed him to charge very high, but then he brought, rather than Fevicol, he brought one unknown brand. So I was a bit unhappy that even after paying such high amount, if you are bringing such non-worthy stock, this is not fair. He said we are using it for 15 years and nothing has happened so far. So then I checked with the brand and it was available in Ahmedabad only. So that was available at around 40 rupees at that time. So then we checked with them, we met with the management, we understood their business model, and we could discover that they are nowhere in comparison to Fevicol. So they are not willing to put any money in advertisement. Rather than that, they tried to ride through the channel, which is carpenters, and they were incentivizing carpenters. So he also explained that there is nothing rocket science in manufacturing. It's kind of simply mixing elements. So the real charm was in marketing. So fortunately, it played very well because they were not generating good profits because they were expanding. So whatever accruals were there, they were being spent into setting up new markets. They had already set up 6 states, and they were already going for another 6 states. Grace of God, it went very well from around 40 rupees. It touched to around 4,000 rupees in a span of about 5 years. So as he rightly said, in microcaps, if a good discovery is there, at least providing some 12 to 16 quarters is a must. So maybe there could be some very short-term opportunities also. In Corona, obviously market, everything was depressed, everything was closed. So our thought process was that there must be something which is in demand. So at that time, what was most in demand was the Corona kit. So company called Killpest, who were into pesticides, were also diversifying into diagnostics. So diagnostic was growing more than this particular pesticide. So we checked with them that why you are not into Corona kits. Then they said we are trying, but that hope was there. It was available at around 45 rupees. And just because they discovered it right time and they got first government tender at around 500 rupees per kit, the manufacturing price cost must be around 10 rupees. So that was a huge boost to them. So in Corona period where everything was depressed highly, this stock become 10x in 3 months. Obviously because of this particular tender.
Maybe the last question before we open up for audience. So, if you could keep it short, what are some red flags that can make a stock completely uninvestable in your opinions? Maybe Balaji, you can say it, and Atul can go next.
Promoter pledge in a microcap can be a bit of a red flag because during a downside, the selling can be accentuated much more. That is point number one. Point number two, related party transactions is something that we need to watch out for as far as microcap companies are concerned. Second, audit fees as a percentage of EBITDA is something that we keep looking at, and quality of auditor and strength of the board. You know, if it's I mean, even there are some microcaps which still make an effort to have decent people in their board. So you can really make out from the profile whether the board is really okay or it's a dummy board. So these are some of the things that we need to look at. And what happens is that you do have a lot of these SME companies that have gotten listed. There are many SME companies, although they have to declare results only once in 6 months, but voluntarily they declare results once a quarter and do conference calls and interact with. So those are like real the 180 degrees of red flag, right? But the companies which want to stick to only that with very minimal disclosures and not really kind of forthcoming, then you need to keep a watch out for those kind of companies.
Like to add?
Yeah, if as in previous session he was explaining, if number of shareholders is increasing constantly, price is going up, so maybe that's a warning sign that the stock is being distributed to many holders. In large cases, we can see even in large caps, this has happened with earlier in Yes Bank or Idea. If you see number of total shareholders, that has swelled a lot. Another thing that where we have burned our hands is that if promoter has a private business, which is an unlisted entity in similar line, and then conflict of interest is obviously going to be there. So that is another flag that normally we track. Another flag is if profits are not matching with the cash flow. So maybe whatever is inflation is there into, it goes into receivables, which later on does not realize. Even there are cases where later on they have reverted the income itself. In one quarter there was some turnover, in next quarter the turnover came negative because they reverted the income booking. So these are main red flags so far we have come across.
Thank you so much, Atul and Balaji.
Thank you.
Thank you.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.